Welcome to Vskills YouTube channel. In this video, you will learn about the top interview questions for financial services marketing. So, let's get started. Question number 1. Why are financial services considered important? The answer is: financial services enable the government to raise both short-term and long-term funds to meet both revenue and capital expenditure. Also, through the money market, the government raises short-term funds by the issue of treasury bills. These are purchased by commercial banks from out of their depositors' money. Question number 2. What are the different forms of financial leases? The answer is: the different forms of financial leases are capital lease, operating lease, sale and leaseback, leverage lease, international lease, domestic lease. Question number 3. Name the type of mergers. The answer is: the type of mergers are horizontal merger, vertical merger, conglomerate merger, acquisition. Question number 4. What are the primary functions of financial markets? The answer is: the primary functions of financial markets are price determination, funds mobilization, liquidity, risk sharing, easy access, reduction in transaction costs and provision of the information, capital formation. Question number 5. What is the purpose of housing finance? The answer is: a housing finance system's objective is to offer cash for home buyers to purchase their properties. This is a straightforward goal with a finite number of options for achieving it. Despite this basic simplicity, extraordinarily intricate home financing systems have arisen in a number of countries, largely as a result of government activity. The ability to transfer funds from investors to those purchasing homes, however, must remain a key part of any system. Question number 6. What are the various types of factoring? The answer is: the various types of factoring are recourse factoring, non-recourse factoring, domestic factoring, export factoring, disclosed factoring, undisclosed factoring, advance factoring, maturity factoring. Question number 7. Explain hire purchase. The answer is: hire purchase is a type of installment purchase in which the businessman, hirer, agrees to pay for the equipment in several installments over time. This payment covers the principal and interest costs associated with the acquisition of an item throughout the duration of the asset's use. Question number 8. What is fee-based financial services? The answer is: financial services are products and services provided by financial institutions such as banks of various types to facilitate various financial transactions and other related activities in the world of finance, such as loans, insurance, credit cards, investment opportunities, and money management, as well as providing information on the stock market and other issues such as trends. Financial services that are paid for a flat charge rather than commission are known as fee-based financial services. Question number 9. Define venture capital. The answer is: investors contribute venture funding to startup enterprises and small organizations that are thought to have long-term growth potential. Venture capital is an important source of funding for startups that do not have access to traditional sources of funding. For investors, the risk is usually significant, but the disadvantage for the startup is that venture capitalists usually have a say in corporate choices. Question number 10. What is the difference between mergers and acquisition? The answer is: a merger occurs when two businesses of roughly comparable size decide to function as a single entity rather than being owned and operated separately. In order for a merger to take place, both firms must relinquish their stock in order to form a new company and issue new stock. Whereas, an acquisition is when one company buys the other. In a merger or acquisition, the acquiring business will be entitled to all of the target company's assets, properties, equipment, offices, patents, trademarks, and other intellectual property. The acquirer will either pay cash or grant compensation in the form of shares in the acquirer's company. Question number 11. Explain the term loan. The answer is: a loan agreement is in which a lender lends money or property to a borrower in exchange for the borrower agreeing to return the property or repay the money at a later date, usually with interest. Typically, a loan has a fixed repayment period, and the lender must take the risk that the borrower will not repay the amount. Question number 12. What is forfeiting? The answer is: export trade finance method, particularly when dealing with capital products or high-risk countries. A bank advances cash to an exporter in exchange for invoices or promissory notes guaranteed by the bank of the importer. The amount advanced to the exporter is always without recourse, and is always less than the invoice or note amount because the bank discounts it. The discount rate is determined by the terms of the invoice or note as well as the level of risk involved. Question number 13. What are the disadvantages of factoring? The answer is, some of the disadvantages of factoring are: the cost will mean a reduction in your profit margin on each order or service fulfillment. It may reduce the scope for other borrowings, book debts will not be available as security. Factors will restrict funding against poor quality debtors or poor debtor spread, so you will need to manage these funding fluctuations. Question number 14. Explain the term lease agreement. The answer is: a written or implied contract in which the owner of a specific asset, such as a parcel of land, a building, equipment, or machinery, grants a second-party exclusive possession and use of that asset for a specific period and under specified conditions in exchange for a periodic rental or lease payments. Question number 15. What is portfolio management? The answer is: portfolio management is the art of establishing the best investment policy for an individual in terms of least risk and maximum return. Portfolio management is the process of managing an individual's investments, such as bonds, stocks, cash, and mutual funds, in order to maximize returns within a set time frame. The term portfolio management refers to an individual's money being managed under the expert guidance of a portfolio manager. Question number 16. Define domestic factoring. The answer is: domestic factoring refers to the acquisition, funding, management, and collection of short-term accounts receivable deriving from the supply of goods and services to domestic customers. Goods are distributed on a 180-day open account credit basis. Question number 17. Define loan syndication. The answer is: the process of enlisting numerous different lenders and supplying various sections of a loan is known as loan syndication. Loan syndication is most common when a borrower seeks a big sum of capital that is either too large for a single lender to give or outside the risk exposure limits of that lender. As a result, many lenders collaborate to supply the borrower with the funds they require. Question number 18. What are the benefits of foreign collaboration? The answer is: the benefits of foreign collaboration are: optimum utilization of resources, technical assistance, economic development, improved standard of living, improves balance of payment, international relationship. Question number 19. Explain debt restructuring. The answer is: debt restructuring is the process of reforming a company's whole debt capital. It entails rearranging the balance sheet items, which comprise the company's debt commitments. A company's financial manager must always consider methods for lowering the cost of capital and increasing overall efficiency, which necessitates a continuous evaluation of the debt portion and recycling it to optimum efficiency. Question number 20. Define equity restructuring. The answer is: the process of reforming equity capital is known as equity restructuring. It entails reorganizing the shareholders' capital as well as the reserves that appear on the balance sheet. Restructuring equity and preference capital is a complicated process that involves a legal process and is heavily regulated. Question number 21. Explain international factoring. The answer is: international factoring is a clever and straightforward notion. Factoring acts as a form of export insurance. Factors, who normally work for a factoring company, guarantee the exporter's import price. The exporter is the one who employs the factor. The cash flow from the importer to the exporter is entirely in the hands of the factor. Credit is essentially outsourced to the factoring provider. Question number 22. Define service economy. The answer is: the service sector, also known as the tertiary sector, is the third tier in the three-sector economy. Instead of product production, this sector produces services, maintenance and repairs, training, or consulting. Question number 23. What are development banks? The answer is: development banks are institutions established primarily to provide infrastructure for a country's economic development. They offer financial support to both governmental and private sector businesses. Question number 24. What is financial planning? The answer is: the process of evaluating the capital necessary and selecting its competition is known as financial planning. It is the process of establishing financial rules for an organization's purchase, investment, and administration of funds. Question number 25. Explain the term financial management models. The answer is: Financial modeling is the process of constructing a spreadsheet that contains a summary of a company's expenses and earnings and may be used to evaluate the impact of a future event or decision. Question number 26. What is interest rates analysis? The answer is: banks and other lenders will lend money to consumers at a certain interest rate. It's their profit margin, their product is debt, and the interest rate, represented as a percentage, is how much money their consumers pay for it. Question number 27. What do you understand by service recovery? The answer is: service recovery is the process of including customer satisfaction into the definition. Service recovery as it is a thought-out, planned process of returning aggrieved or dissatisfied customers to a state of satisfaction with the company, or service recovery that differs from complaint management in its focus on service failures and the company's immediate reaction to it. Question number 28. What do you understand by green marketing? The answer is: green marketing refers to the marketing of products that are assumed to be environmentally safe, such that green marketing incorporates a range of activities, such as product modification, production process changes, sustainable packaging, as well as modifying advertising. Question number 29. What do you understand by service blueprinting? The answer is: service blueprinting refers to an operational planning tool that offers guidance on how a service will be provided, by specifying the physical evidence, staff actions, and support systems as well as the infrastructure required to deliver the service across its different channels. Question number 30. What do you understand by market targeting? The answer is: market target refers to a group of customers, a business that decided to aim its marketing efforts and ultimately its merchandise towards a well-defined target market is the first element of a marketing strategy. Basically, a target market refers to a group of people considered likely to buy a product or service. For more such videos, subscribe to our channel.